Will the real estate market crash in 2022? With all the headlines and buzz in the media, some folks believe the market is in a housing bubble. As real estate markets begin to shift, which we're seeing, you may wonder what will happen next. It's only natural for concerns to creep in that it could be a repeat of what took place in 2008. That's pretty recent. The good news is there's concrete data to show why this is nothing like the last time. Give me 2 minutes and I'll show you why. First of all, there's still a shortage of homes on the market today, not a surplus. Supply of homes needed to sustain a normal real estate market is approximately 6 months. Anything more than that is an overabundance and will cause prices to go down. Anything less than that, which is what we have right now, is a little bit of a shortage and will continue to push prices up. For historical context, there were too many homes for sale during the housing crisis, many of which were short sales and foreclosures, and that caused prices to tumble. Today, the supply is growing, but there's still a shortage of inventory available. The graph below uses data from the National Association of Realtors to show how this time compares to the crash. Today, unsold inventory sits at about 3 months supply at the current sales pace, and that's very true of Phoenix. One of the reasons inventory is still low is because of sustained nationwide underbuilding. When you couple that with ongoing buyer demand as millennials age into their peak home buying years, it continues to put upward pressure on home prices over the long haul. That limited supply compared to the buyer demand is one reason why experts predict home prices won't fall this time or fall very much. Second, mortgage lending standards are still strict, unlike during the 2008 crash. During the lead up to the crisis of 2008, it was much easier to get a home loan than it is today. Pretty much if you were breathing, you could get a loan. The graph below showcases data on the Mortgage Credit Availability Index from the Mortgage Bankers Association. The higher the number, the easier it is to get a mortgage. Running up to 2006, banks were creating artificial demand by lowering lending standards and making it easy for just about anyone to qualify for a home or refinance their home. Back then, lending institutions took a much greater risk in both the person and the mortgage products offered. That led to mass defaults and foreclosures and falling prices. And they learned their lesson. Today, things are very, very different, and purchasers face much higher standards from mortgage companies. Buyers today need to make a down payment, they have to have good credit, and enough verifiable income to support making the loan payments. Stricter standards like there are today help prevent a risk of a rash of foreclosures like there was the last time. Third, on foreclosures, the foreclosure volume is nothing like it was during the crash. The most obvious difference is the number of homeowners that were facing foreclosure after the housing bubble burst. Foreclosure activity has been rising, but it's still just a tiny fraction of what it was during 2008. The graph below uses data from Atom Data Solutions to tell the story. Lastly, homeowners today are equity rich, not tapped out like they were in 2008. In the run-up to the housing bubble, some homeowners were using their homes as personal ATMs. Many immediately withdrew their equity once it built up, and when the home values began to fall, some homeowners found themselves in negative equity situations where the amount they owed on their mortgage was greater than the value of the house. Some of those households decided to walk away from their homes, and that led to a huge wave of distressed property listings, foreclosures, and short sales, which sold at considerable discounts that lowered the value of other homes in the area. Today, prices have risen nicely over the last few years, and that's given homeowners a huge equity boost. According to Black Knight, which researches how much equity the average homeowner has, they found that there was a $2.8 trillion in untapped equity in the last 12 months alone. That equates about 207 per home on average. With all that equity, homeowners aren't likely to walk away. They may sell, but they're certainly not going to walk away. The bottom line is, if you're worried about making the same mistakes that led to the 2008 housing crash, the graphs above should help alleviate your concerns. Concrete data and expert insight clearly show that this is nothing like the last time. If you'd like help with your individual real estate needs, just call or text me, 602-430-5755. Thanks for your time. Bye-bye now.